Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, with the Moose, John Mousseau, President and CEO. Few things we want to go over, and I'm going to cede most of this to John this week because we had plenty of action in the bond market, a big print today.
We did.
So we'll go over that. In terms of equities, again, we had such extreme volatility. Friday, let's call it, was it Jan 24th through that front end of last week, that the market appears to have wiped out a good amount of sellers. And you saw this week, anytime the market sold off, it got bought. So interesting to see how that leads in to next week. Very important to realize that barbelling of portfolios on the equity allocation is very necessary here. Take a look at this week. Financials, a good basket of financials go out at 52-week highs. Energy go out at 52-week highs. You don't even know there's a volatility in the market. Have to have some of those names in the portfolio. We added Schwab back on Monday. Schwab had pulled back from the this is in tactical trend, by the way. Sometimes I forget to say the strategy, and somebody will say, wait, you didn't buy Schwab for me. We bought that in tactical trend, pulled back from the mid-90s to 85, 86. We added that to tactical trend, traded well the rest of the week. Higher rates should be beneficial to financials. We've been saying that now for 6, 8, 10 months. Look at the insurers this week. MetLife, all-time high. So we'll be keeping our eye on adding there. We're in tactical, we're very pleased. Berkshire Hathaway traded beautiful with Geico. Wonderful action out of Schwab. And JP Morgan has come back off of that, let's call it a half an earnings miss, where they couldn't contain costs on labor. And that's something we'll have to keep an eye on. In terms of some ideas to think about, a couple things. When markets get volatile, slow down. I've said this a number of times. You're going to have multiple opportunities to buy quality. Don't have to jump in at the first pullback. Slow down, get into names in stages. Charles Schwab, we only bought a 3% position. The idea is to build that to a 5, 6, 7% position. But there was no reason to guess at 85 and change that was a low. So it's a nice way to start building positions into volatility. Volatility and risk are two different things. With bank balance sheets as strong as they are, I look askance at some of this 2008 talk that we hear. Completely different market. Is there volatility? Absolutely. Can you get stung in this market? Absolutely. But you can also look at it as opportunity. So I went a little longer than I was going to, but Moose, what do you have in bondland?
Bondland this week, yields higher, but in Treasuries, not in Munis. Muni yields came down this week a little bit, making up for some of the erosion of last week. But what happened? 10-year bond went from a 177 to a 193. It is now higher than it was at the beginning of 2019. And we have a graph up there to show you. And it's been a long, strange trip on the 10-year bond yield, but we are back to where we were, slightly higher than we were before the pandemic began.
Pre-COVID.
Pre-COVID, exactly. The 30-year bond went from a 207 up to about a 223. These are both 16 basis point hikes. That's a fairly big move. And why did we have this big move? We had the big move because this week, kind of a follow through to some of last week, people concerned about the Fed raising rates, people concerned about the Fed reducing their balance sheet. And then you get a number like today, where the jobs number, people were expecting 150, 175 in new jobs, and the print is 460.
Yeah.
Off the charts. Now, is there a lot of noise in there? Yes. What's the message, though? The message is that companies were not waiting around on Omicron to clean up before they go and get new workers. So people were hired. Another very, very good sign, if you looked at unemployment. Unemployment ticked up from 3.9 to 4.0. But the backdrop to that is that the labor participation rate, the number of people in the workforce looking to work, crept up from 61.9 to 62.3, something like that.
And that's a percentage number you're using?
Percentage number of total people working. Used to be much higher years ago, but the idea from these low levels that we were, more people are getting back into the workforce, and that is a great sign. So from where we sit, we expect to see interest rates continue to kind of grind higher. We do expect inflation to start to come down. Next week, we're going to be looking at CPI and PPI, and we expect those monthly numbers to come down from where the lofty levels they've been at. However, and you'll hear this being crowed about, boy, they say we've tackled inflation. You'll know it when you finally get to a longer term run rate, and we expect that to not be at the level of 7 where we are now, but probably to level off at something around 4, etc. And as you level off, you'll see interest rates start to move up to match that. So what you have now is a market that realizes that the inflation isn't really as transitory as the Fed wanted us to believe, but it will drop a little bit. But this is the adjustment process that we've been talking about. At Cumberland, we've started to buy a few longer bonds that we have not done in well over a year, and we do see some opportunities.
Good. Yeah, markets are trying to discount it's oversaid, but a regime change, right? We've been used to low rates going lower. We got a little dose of it in late 18, right? When the market had to try to price in some of Powell's language. It's going on now. One interesting thing, and Stanley Druckenmiller had a nice piece on that this week. He's impressed with Powell and the Fed talking about flexibility in data going forward.
Absolutely.
Not making decisions today about what may be going on in 9 months, 10 months, 12 months. Look at the data, see how they have to react, try to contain this inflation. At the same time, the equity market is a discounting machine. It's trying to look out 6 months, not today, 6 months to try to come up with a valuation that people can live with. Once we get that priced in, maybe some of this volatility starts to subside.
I would add one more thing to that, Matt, too. The fact that you do have some higher interest rates, part of that can be ascribed to the fact that the Federal Reserve is getting out of the ball game, right? They're going to be buying less bonds. They're going to be buying no bonds after next month. And they'll start to raise some short-term interest rates. In other words, it's a step towards normal. And that step towards normal is a great sign of the faith that the Fed has in the economy to handle things.
Right. Right.
It's almost like Jay Powell is saying, our work here is done.
Good point. Okay, thanks for joining us. Don't forget to like, comment, and subscribe in case we have a midweek alert next week if things get volatile like they did a week ago. In terms of the weekend, enjoy it. Have your helmets on because next week we'll bring plenty of action. Have a great weekend.